We will have more on the price of oil coming up. But first, Robert Brusca is chief economist with FAO Economics, and he has some thoughts on Yellen's comments and what she and the Fed are trying to telegraph in their usual Fed speak. Bob, welcome to Arise Xchange. Good to see you.
Thank you.
So first, what was her comments about the stock market today?
Well, I think she was trying, the expression, have her cake and eat it too, she was trying to not have her cake and not eat it. She was telling us that there's some small problem with overvaluation, but she said there isn't a problem with financial stability. So I think she was trying to admit that there's a little bit of overvaluation in the market, but at the same time trying not to create a panic by it.
Should the Fed chair be commenting on stocks? Is she a stock market analyst?
I don't think so, no. But the Fed winds up talking about stock markets. You know, there's always this question about bubbles, and especially with interest rate policy being so low for so long, there's a question of whether they've overdone it. And so I think the Fed is somewhat sensitive. I think if you look at long-run measures of, stock market valuation, price-earnings ratios, the market looks a little bit rich. It doesn't look terrible. I don't think that she said anything today that was devastating.
Most of the analysts in here said that valuations are about where they should be or a little bit overvalued, but it's certainly not what they're calling a bubble. But she does address the point of valuations, and I'm wondering if she is telegraphing and trying to prepare the market for an interest rate hike.
Oh, yeah, the Fed's been trying to do this for some time. The problem is that the economy isn't behaving. Last year and early this year, we were pumping out over 200,000 jobs, 250,000 a month for a while, and now things have slowed down. Just today, the ADP report came in, for the second month in a row, a lot weaker than it had in prior months. It looks like the job growth is slowing down just at the time that the Fed wants to raise rates. The economy is not cooperating, and Yellen is there warning that they're going to raise rates, and the economy is saying, please don't.
And certainly on Friday, we're going to get a jobs number that the Fed is going to very much be looking at.
Yeah, well, that's the thing. The ADP that was out today is a precursor to that report, and the ADP would suggest that this is not going to be a strong job report, but sometimes those two reports do uncouple, so you do still want to watch what happens on Friday.
She talked about financial stability, which you mentioned at the top of the interview. What key points is she saying that we are in a more financial stable position than we've been?
Well, that she thinks that basically banks have more capital and that the system is more prepared to deal with difficulties. So it's possible that the stocks are overvalued, and it's possible you could have a market sell-off, but she doesn't think it threatens the financial system in any way. Same with the bond market. Bond yields are low. They've been creeping up. They think the Fed's going to raise rates, so you've got to creep up in yields. She's saying don't worry about it because financial stability isn't an issue. These are market dynamics.
And basically market dynamics, that bond yields are going to go up, stocks are going to go down, but the world is going to be okay. But there's a lot of people out there who's saying the Fed has no choice but to say this because it doesn't want to get back into a quantitative easing strategy.
Well, that's true. Your mother comes into the bedroom and says, don't worry, there's no boogeyman under your bed, and that's the Fed chairman's job.
Okay. So looking forward then, what metrics are the Fed's going to look at when it comes to interest rates? Because we are thinking maybe interest rates in June, that's probably off the table, right? Maybe September?
Right, June's off the table. September may be a possibility. I don't think they're going to raise rates to next year myself. I think the Fed's not going to find strong enough economic growth this year to justify it.
However, you also note that if they do raise interest rates, the economy here and abroad will be okay.
Well, a small interest rate hike isn't going to have that big an impact on the economy. The big problem, I think, is that the Fed starts raising interest rates, especially if markets think it's not justified, is the impact it could have on the dollar. The dollar has been very strong. It's been backing off since the economy has been weak, and people thought the Fed was perhaps going to have to push off its plans. So if the Fed pushes up its plans again, then you're going to see the dollar moving up, and that seems to have some adverse impact on growth. So you really don't want to move the dollar up very strongly from where it is.
Okay,
that would not be a good thing.
So your takeaway from Janet Yellen today, no surprises?
I think no surprises. I think she's trying to do her job. She's trying to say, yeah, there may be some issues in the markets, but financial stability is not a problem. Sleep tight.
Okay, Bob Brusca, chief economist with FAO Economics. Thank you so much.
Thank you.
Good to see you. See you again soon. We have